Is this stock a massive undervalued AI buy ready to break out? Or are flashing sell signals warning of a dangerous retail value trap?
I mean, the market is currently waging a multi-million-dollar tug-of-war over that exact question. And the friction is, well, it's generating some historic volatility right now.
Right. Welcome to today's deep dive. It's April 20, 2026, and we are opening up a stack of deeply conflicting data on Applied Digital Corp. Ticker symbol is APLD.
Yeah, and it's a fascinating one because you have explosive revenue growth and incredibly bullish momentum on one side of the ledger, right?
Exactly. But then on the other, you've got this staggering cash burn, heavy debt, and executive insider selling that definitely raises some immediate red flags. We're going to unpack the mechanics of what is actually happening under the hood here.
We really need to look at the whole picture to figure out what's going on.
For sure. But before we get into the balance sheet, you know the drill. Like this video, hit subscribe to our YouTube channel, and honestly, it is compulsory that you leave your feedback in the comments.
Yeah, we want to know where you stand on this debate. Are you buying the AI hype or running for the exits?
Because the hesitation from retail investors is, it's entirely justified when you look at the raw price action.
Oh, absolutely. We are talking about a 52-week range that stretches from a low of $3.81 all the way up to a high of $42.27.
Which is just insane. Over 1,000% swing from trough to peak in a single year. When you pull up a chart with that kind of verticality, it's intimidating.
It really is.
It feels less like evaluating a standard tech equity and more like, I don't know, trying to look at a roller coaster that you aren't quite sure you're tall enough to ride.
That's a great way to put it. A swing that violent indicates a market that is fundamentally struggling to price in the company's future.
Right. So let's ground this in today's tape. To understand how a stock swings from under $4 to over 40, we have to look at what it's trading at today. Where did APLD actually close?
So it closed today at $32.19. That's picking up 66 cents for a 2.09% gain on the day.
Okay, solid green day.
Yeah, but the closing price really obscures the sheer mass of capital flowing through this ticker right now. I mean, we saw 22.17 million shares trade hands today.
Wow, over 22 million.
Yeah. And if you look at the recent order flow, the daily trade values are routinely exceeding $700 million.
Wait, $700 million changing hands daily?
Yeah.
That means we aren't just looking at retail day traders chasing a trend on a message board.
No, not at all. That is heavy institutional accumulation or distribution. You don't see that kind of volume unless hedge funds and asset managers are repositioning.
Right, and bullish pressure has really been building.
Exactly. The institutional interest kicked into high gear after their April 8 earnings beat. But the underlying catalyst driving this massive daily flow is, well, it's a fundamental shift in their core business model.
The big AI pivot.
Exactly. Applied Digital is executing this highly capital-intensive pivot. They are abandoning their legacy crypto hosting infrastructure and going all in on high-performance computing, specifically building out massive AI data centers.
Okay, I want to push back on the logistics of that pivot for a second, because, on paper, moving from crypto mining to AI data centers sounds like a software update or a simple rebranding exercise.
Right, like you just swap out some servers and you're good to go.
Exactly.
Yeah.
But physically, these are fundamentally different operations. A legacy crypto mining facility is essentially a giant, relatively cheap warehouse, right? With just industrial fans blowing across racks of basic ASICs.
That is the core of the challenge here. The market is pricing in the word AI without always grasping the physical engineering required to actually host it.
It's like a trendy neighborhood cupcake shop suddenly deciding to become a high-end luxury steakhouse overnight.
Yeah, that's a perfect analogy.
Like, it sounds incredibly lucrative on paper, but the kitchen renovation costs to make that happen must be astronomical, right?
Oh, they are. Because to run next-generation GPUs for artificial intelligence, you cannot just repurpose a crypto shed. AI clusters require entirely different power density profiles.
So you need more juice.
Way more. And they require advanced liquid cooling systems because the thermal output is just exponential compared to crypto mining.
Right, because those GPUs run unbelievably hot.
Exactly. Plus, you need reinforced flooring to handle the sheer weight of these high-density racks and industrial-grade fiber optic backbones to handle the data throughput.
So they aren't just flipping a switch. They are tearing the car down to the chassis and trying to drop in a jet engine.
That's exactly what they're doing. And the physical friction of sourcing liquid cooling infrastructure and specialized transformers in today's supply chain environment, it's brutal.
Which leads us right into the financials.
Yeah.
because that physical friction has to be bleeding directly onto their income statement. Let's look at the hard numbers from their fiscal Q3 2026 report.
Right, so the top-line growth definitely reflects the aggressive rollout. They brought in $126.6 million in revenue.
Wow.
Yeah, which is a 139% increase year over year.
Triple-digit revenue growth.
Yeah.
I mean, that is usually the metric that gets growth investors aggressively hitting the buy button.
Yeah.
But growth at what cost?
Well, at the cost of a massive widening deficit on the bottom line. The net loss for the quarter expanded to $100.9 million.
Hold on. So they have triple-digit revenue growth, but they're losing $100 million a quarter.
Yeah, it's a tough pill to swallow. Earnings per share came in at negative 36 cents, which actually missed the analyst consensus of negative 13 cents.
Aren't they essentially building the airplane while in free fall at that point?
Yeah.
If revenue is up 139%, but they are losing over $100 million in a single quarter, the margin compression is just brutal.
It really is.
Where is that cash specifically vaporizing? Is it purely the hardware procurement you mentioned?
It's a combination of staggering capital expenditures CapEx and the resulting depreciation.
Okay, break that down for us.
So to build these AI data centers, their CapEx has hit a negative $681 million.
Wait, $681 million?
Yeah, that is the cost of putting steel in the ground, laying fiber, and installing those liquid cooling loops.
Yeah.
And because they are capitalizing these massive infrastructure investments, the depreciation hits the income statement really hard. Ah, I see.
Yeah, it drags down the net income even as the top-line revenue from early contracts starts to flow in.
This brings us to the balance sheet because, I mean, you cannot sustain a $681 million CapEx burn without a massive war chest. How are they financing this pivot?
Well, they recognize the scale of the capital required, obviously, and they recently secured a massive $2.15 billion financing package.
$2.15 billion. Okay.
Yeah. So right now, total assets sit around $1.87 billion. Their immediate liquidity isn't actually the issue. Their current and quick ratios are sitting around 2.38.
Meaning they have the cash on hand to keep the lights on and pay short-term vendors.
Exactly. The issue is the leverage. They are currently carrying a debt-to-equity ratio of 1.65.
A 1.65 DE ratio in a high-interest rate environment is a heavy anchor to drag around.
It's huge.
So they're borrowing billions to cross this infrastructure chasm, basically betting that the high-margin AI contracts waiting on the other side will be lucrative enough to service that debt. Right. And the cash flow statement really highlights the depth of that chasm. They are running at a negative $115.4 million in operating cash flow.
So they're bleeding cash from operations, too.
Exactly. They are fundamentally racing against the clock to bring 300 megawatts of AI capacity online before the interest payments and operating burn consume that $2.15 billion lifeline.
Okay, so here is the contradiction that makes APLD such a fascinating study for you as an investor. You have a company burning 9 figures of cash a quarter, carrying heavy leverage, and missing EPS estimates. Right. By traditional value metrics, the market should be violently punishing the stock, yet we are sitting at $32.
Yeah, it defies traditional logic.
Let's look at the technicals, because if the financials show a company burning cash like jet fuel, the charts tell a story of traders who are just entirely ignoring the debt.
Yeah, from a technical perspective, the price action is stubbornly bullish. The trend-following indicators are basically screaming, strong buy.
Really? Even with that debt load?
We are trading significantly above all major moving averages. The 200-day is way down at $25.11, and the 50-day is trailing at $28.66.
So the long-term trend is up?
Exactly. But more importantly, the short-term momentum is holding. It's trading above both the 20-day at $26.63 and the 5-day at $30.30.
Wow. When a stock gaps up and sustains its price above the 5-day and 20-day averages, it shows that short sellers are really struggling to find any real traction.
Yeah, they're getting run over. Every time the price dips, new buyers are stepping in to absorb the float.
Where are the key battlegrounds on the chart right now? Like, what support and resistance are we looking at?
Well, the support layers are well-defined. Buyers have established a very firm floor right around $28.60, which beautifully coincides with that 50-day moving average we mentioned.
Okay, so 28.60 is the line in the sand.
Right. If broader market weakness drags it below that, there is secondary support at $27.10 and then the 100-day at $26.60.
What about the upside?
On the upside, the immediate ceiling they need to shatter is the recent high of $32.55. If they break link that with volume, the technical path is relatively clear toward the psychological resistance of $40.03.
Looking at the momentum oscillators, are we seeing any signs of exhaustion at these levels?
Not really. The MACD is positive at 0.65, indicating the trend is still firmly in the bull's favor, and the RSI is hovering right around 60.
Okay, so let me clarify that for the listener. An RSI of 60 is like driving 60 miles per hour on the highway. You've got great forward momentum, but the engine isn't redlining into that dangerous, overbought territory just yet.
Yeah, that's exactly right. You typically expect an aggressive pullback when RSI pushes above 70, so there is solid upward momentum here. Short-term forecasts actually predict a slight upward crawl toward $33 by early May.
Okay, so the technicals say strong buy, and they align perfectly with the revenue growth narrative.
Yeah.
But this is where we have to look at the valuation models.
Yeah, this is where it gets tricky.
Because the disconnect between Wall Street's price targets and what the company's own insiders are doing is just glaring. This narrative gets so contradictory.
It is the most polarizing aspect of this entire deep dive. If you look at Wall Street, 11 analysts cover APLD. Their consensus rating is a resounding strong buy.
11 out of 11.
Yep. The average price target is $50.09. That implies a massive 55% upside from today's price.
That's huge.
And the most aggressive models even put a high target of $97 on the stock.
$97.
Mm-hmm.
I mean, to justify a $97 price target on a company with a massive net loss, analysts have to be modeling out several years into the future. They're assuming flawless execution of that 300-megawatt build-out.
Zero supply chain hiccups, seamless client onboarding.
Exactly. They're pricing in absolute perfection.
They are entirely pricing the stock based on forward-looking high-margin AI infrastructure contracts. Models suggest a fair value of $45 to $50, but that relies on a terrifyingly high premium. Let's talk about the price-to-sales ratio.
Great.
The industry average PS for this sector is roughly 1.7x. Applied Digital is currently trading at a PS of 25.9x.
A multiple of nearly 26 times sales.
Yep.
When a company is trading at that kind of premium, the stock is priced for absolute perfection, which makes the share price incredibly fragile. If they miss a construction deadline by a month, or if a shipment of cooling equipment is delayed at a port, that 25.9x multiple will compress violently.
It will collapse, and that fragility is what makes the recent insider trading data so alarming. Over the last 24 months, insiders, so the directors and officers actively managing this pivot, they have sold over $31.6 million worth of their own stock.
$31.6 million. That is a systemic exit of capital from the people who have the clearest view of the company's internal metrics.
And it is accelerating. On April 4, just a couple of weeks ago, CEO Wes Cummins sold approximately $2.46 million worth of shares at $24.56.
Wow.
And on that exact same day, the CFO, Mohammed Momen, sold roughly $789,000 worth of stock.
Okay, hold on. This is the exact contradiction that retail investors have to zero in on. If Wall Street is screaming that this is going to $50 or even $97, why in the world is the CEO cashing out $2.5 million at $24.56?
It's a great question.
Doesn't that smell exactly like a trap for retail investors? If you are steering the ship and you genuinely believe your infrastructure pivot is going to double the share price, you don't liquidate a multi-million-dollar position in the mid-20s.
It definitely creates the classic profile of a retail value trap. A PS of 25x combined with heavy insider selling is a classic negative signal. But the bullish argument to defend the CEO here is diversification.
How so?
Well, APLD went on a historic run from $3 to $40. If a massive percentage of an executive's net worth is locked up in a single highly volatile stock, selling a fraction of those shares at $24 is just sound wealth management. It doesn't inherently mean they foresee a total collapse.
Sure, I get that. But when you pair heavy executive selling with a price-to-sales multiple of nearly 26, it shifts the risk profile dramatically.
It does.
It suggests the insiders are securing their wealth at premium valuations, while retail traders are the ones left holding the bag, assuming all the execution risk of this AI build-out.
Exactly. Which brings us to the actual downside risks. The CEO's willingness to sell at 24 leads directly into this. If things go south, what exactly are the hazards that could wipe out retail traders?
Right, because if you are holding this stock at $32, you need to know exactly what could trigger that multiple compression.
First up is customer concentration. APLD is heavily reliant on a few hyperscalers, those massive cloud service providers that consume unbelievable amounts of computing power. Right now, their anchor client is CoreWeave.
Having a whale like CoreWeave as a client is fantastic for revenue validation, obviously, but it creates a dangerous single point of failure.
Extremely dangerous. If CoreWeave adjusts its own internal strategy, decides to build out its own proprietary data centers, or even just aggressively renegotiates their contract terms, APLD's forward revenue projections evaporate.
And when you are carrying a 1.65 DE ratio, you do not have the flexibility to survive losing an anchor client.
No, you don't. And beyond execution risk and client concentration, there is the extreme volatility. Let's look at the beta. APLD currently has a beta of 7.25.
7.25. I mean, having a beta of 7.25 isn't just riding a roller coaster, it's riding a mechanical bull during an earthquake.
That is painfully accurate.
It makes it wildly sensitive to any broader tech market sell-offs. If the broader tech market even sneezes, APLD catches pneumonia.
Right. It amplifies the macro environment. If the tech sector experiences a routine 2% pullback, APLD is statistically positioned to swing violently downward. So
Yeah.
we're really looking at two highly polarized timelines for this company. Let's map out the bull and bear cases.
Okay, let's start with the best case scenario. The bull case.
So in the bull case, that $2.15 billion financing is deployed flawlessly. They avoid supply chain bottlenecks, they secure the necessary transformers and liquid cooling loops on time, and they bring that 300 megawatts of AI capacity online perfectly on schedule.
Right, and those new high-margin AI contracts rapidly replace the lost crypto revenue.
Exactly. The operating cash flow flips positive, and they basically grow into that 25x multiple, pushing the stock toward that $50 consensus target.
And the bear case, the worst case scenario, maps to the friction of reality. What happens if things go wrong?
Delays happen. The permitting for these massive data centers gets held up. The specialized grid hardware takes 6 months longer to arrive than projected.
And if those delays materialize, the cash burn just continues at $100 million a quarter, right?
Yep. Without new revenue coming online to offset it, the negative net margins continue. And with that 1.65 debt-to-equity load, the servicing costs become suffocating.
So to avoid default, the company would be forced to issue new shares.
Exactly. Heavily diluting the existing retail shareholders. That share dilution, combined with missing forward guidance, shatters the PS multiple, and the stock price just collapses back into the single digits.
When you lay out the data like this, it becomes so clear why the daily trading volume is massive. The market is trying to price in two completely distinct realities.
Yeah, it's a true crossroads.
You've got the technical charts showing aggressive buying momentum and the 139% revenue growth validating the pivot. But then you have the $681 million CapEx burn, the heavy debt leverage, and the millions of dollars in insider selling at lower prices, signaling severe structural risk.
So if we distill this down to an outlook summary, bringing it back to your perspective as the investor, in the short term, over the next few days and weeks, the bullish technical momentum persists. The buyers are stepping in at support, and the path of least resistance remains upward toward $33.
But the medium to long term?
It is entirely dependent on their ability to execute. Can they actually deliver those 300 megawatt data centers without running out of cash? That's the real test.
Right. And as you weigh these contrasting timelines, remember that exploring this data in this natural human debate is strictly for educational deep diving.
Yeah, we aren't here to offer financial advice.
We just want to give you the context necessary to look past the buzzwords and understand how capital actually moves through a company undergoing a transition this volatile.
Because analyzing the why behind the heavy leverage and the insider selling, that's what separates investing from simply gambling on momentum.
Absolutely. So we've looked at the charts, the debt, and the insider selling. But there's one more puzzle piece out there that we haven't touched on today.
Oh yeah, the options.
Exactly. If you want to know what the market really thinks is going to happen next, you need to examine the options chain for upcoming expiration dates. Are the options traders pricing in an explosive breakout with massive call premiums? Or are we seeing market-implied volatility that points to a devastating crash?
That will definitely reveal what the institutional money actually expects.
It's a question for you to explore on your own. Until next time, keep digging.